Hey, good morning, options traders. Happy Monday. I hope everybody had a great weekend after the kind of a wild week that we had last week in the markets, really from about Wednesday to Friday. But Friday, July 26, 2024, rallied back with a vengeance. Mostly on the personal income and outlays number that came out at 8:30, often called the Fed's favorite inflation gauge, and the year-over-year number came in at 2.5%. So it was really in line with expectations, but at least it showed that we're moving in the right direction, moving towards that Fed target of 2%. Had a great day on Friday, and I had a number of people emailing saying, "Hey, I was able to get a lot of rolls off in this market. What do you think about this roll?" And I noticed that a lot of them were rolling for the wrong reasons. So I thought this might help some of you to understand there's a right reason for rolling. Actually, there's lots of potentially right reasons, and there's lots of potentially wrong reasons. But I just want to highlight some of the key ones here. But let's focus on what is rolling for the wrong reasons. So, as always, before we get started, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So, to understand rolling for the wrong reasons, sometimes it helps to start by looking at rolling for the right reasons. And let's begin by looking at a classic case for being able to roll a call option early when you can get a very good opportunity, and that is with the stock replacement strategy. You've heard me talk about this many times. It's one of my most widely used strategies. But this is where you're going to buy a deep in the money call, usually with a delta, let's say, somewhere in the 80 to 85 range. And when you do this, the call behaves a lot like stock, but at a sharply reduced cost. So that's why it's called the stock replacement strategy. It's a way to have a position that behaves like stock, but you're not having to spend as much for it. So, for example, let's say that the stock is 100 and you could buy a 180-day $70 call according to a pricing model says it's worth $31.50. Now, remember, we've talked about this before. People look at this as an expensive option. How much is this option? It's $1.50. It's the extrinsic value. The $30 is just intrinsic value. So it's really a fairly cheap insurance policy to ensure that you don't take losses below 31.50. So let's say that the stock rises to 110. Now that same pricing model says that the $70 call at this day would be worth $40.70. And so this would be our risk graph when we started. So remember, we get a bend at our strike. There's the 70 strike. Here's our current curve in red. So remember that the current curve moves towards the black curve and eventually becomes the black curve at expiration. And that difference between the red and the black curves is your theta, your time decay. So with the stock up here at 110, where's the danger? Is there a danger here? We've talked about this before. Remember what a danger is. A danger is this term that we give when we have a position that really can't benefit us anymore. Usually happens when we have something like a vertical spread that has a ceiling to it, but it could go against us. So then you have to say, well, what's the point in holding it? Well, can you see a danger in here? Now, a lot of times traders say, no, it's just behaving like shares of stock. It's looking good. Well, not necessarily. We have to dig a little deeper. Remember that this bend down here is the benefit. This is what we're paying for the insurance policy. So if we wanted to roll from the 70 call, let's say, to the 75 call, which is a roll up, and the reason we do that is to get cash off the table and to put some cash in our pocket, reduce that downside risk, but also maintain the unlimited upside. But what are we really doing when we roll? So let's look at this 70 call. How would you roll it? Well, we've got the long 70 call in our account. And to roll it, I would need to sell the 70 call and then buy the 75 call. But look at these as a pair. What is that? That's a short vertical spread. So this is a little shortcut you can use in your broker's platform. Instead of just selling the 70 call and then buying the 75, you do one trade as a short vertical. And when the short vertical executes, look what happens. These cancel. Broker recognizes that you're long and short the $70 call in your account, so they just flatten, and you're just left with the long 75 call. So take a look at what happens. If we look at this as a vertical spread, we can see it down here. And what we're going to do as we roll, we're just selling vertical spreads, and we're just walking up this black line. And as we continue to do that, we are reducing the amount we can lose. See, we used to be able to lose almost 32 bucks down here, and we keep raising this floor. So we keep having more and more cash coming off the table, so we have less risk. But the question that we want to ask is, when should you sell a vertical spread? So let's go back to our $70 call, and we're considering selling this 70-75 vertical spread here in red. Now remember, the stock is up here at 110, and the pricing model is telling us that our $70 call is worth $40.70. Well, what is the value of this vertical spread down here? See, that's something we should look at, because it's really invisible. We don't see it in the account. We just saw this risk graph in black. But we need to understand that it's really made up of a series of vertical spreads. As I showed, we could just walk along this black line. So what's it worth? Well, with the stock up here at 110, the pricing model says this 70-75 vertical spread is worth $4.90. Now remember, the most it could ever be worth is $5. Why do we want to hold on to it? The very best we can make from here forward is 10 cents, and yet we could lose $4.90. So this is a classic example of what we call a danger. But you see how easy it is to miss, because people just look at the long call risk graph right there in black, and they don't realize that there are really embedded vertical spreads in there. So this is a very good reason for rolling. We're not rolling just because we like to get credits. We're rolling to avoid this danger. We don't want it. It's not benefiting us in any way. So this is a great reason for doing a roll. So let's go ahead and close the 70-75 vertical, and as I just showed, we would get a net credit of $4.90. Now our cost basis was $31.50. We subtract out $4.90, that's the credit we just received, so we now have $26.60 into the trade. So here's what the roll looks like before and after. We had $31.50 into it. That was our maximum potential loss. That was our risk graph of the $70 call. And the sale of this vertical spread has now shifted our risk graph from the black to the blue. We now have a floor of $26.60, exactly $4.90 less from that credit from the sale of that vertical spread. This is a fabulous reason for doing a roll. We're getting rid of a danger. And yet if we look at our current graph, we've still retained the manageable risk. That's what we want to keep. We don't want to keep the stuff we can't manage. That's why we get rid of dangers. Okay, so down here, what have we done? We've eliminated the danger. Again, so that's a very good reason for doing a roll. Not the only one, but that's one that I primarily focus on when using stock replacement strategies. So now that you understand an example of a right reason, let's look at a wrong reason. This is what I was seeing from the emails on Friday. So let's say that you have a $100 call purchase for 10. So there's our bend right there at 100. Maximum loss right now is 10 bucks. But let's say the stock is down here. It's an out of the money call. Stock's down around 95 bucks. Well, your expiration break even, where the black line crosses zero, is right there at 110. So if the stock is 110 at expiration, you just get your money back. That's a very big move. Statistically, that's not likely to happen. But here's what people do. They see the market going up like we saw on Friday, and they go, oh, I can roll for a credit. Let me sweep some credits off. And that's what all of these people were doing. But because they're out of the money, you're not going to get much for those short vertical spreads. So a lot of them were, let's say, rolling for $1. So what you've done in a case like this is you've moved from the black to the blue. You used to have a bend right here at 100. Now your bend is at 105. But look what you did to the break-even point. Your break-even point is not at 110 anymore. It's up here at 114. So think about it. When you had the 100 call for 10, we add those numbers together. 100 plus 10 gives us 110. When you rolled for the dollar credit, your net cost is now $9. So 9 plus your new strike of 105 is 114. So look what you did to those break-even points. You pushed them out $4 out, and yet now the stock is maybe up here. So maybe the stock's at 97. Well, now you're 18 points out of the money with less time to go. You've made this far more likely to lose money, albeit only $9 instead of $10. But it's still a loss. All you accomplish with this roll is to really increase the chances for a loss. And so what happens? Later on, they find out they can roll for, let's say, another dollar, sweeping up these very small credits. Well, now maybe they're holding the 110 strike. They've collected $2. So now their maximum loss is 8, but we add it to the 110 strike. All right, we've pushed that break even out here. And now your break even might be 118. So remember, the stock might just be a little bit higher from where it was. So if the stock is maybe up here at 98, break even's at 118, now you're 20 points out of the money. So yes, you're collecting these credits. You think you're doing yourself a favor, but you're just increasing the chances for a loss. You're really digging a deeper hole. So remember, you can always roll for credits. That's a basic pricing principle. When you sell a lower strike call and buy a higher strike call, you will absolutely get a credit. So don't be surprised that you look at your broker's platform and go, oh, I can get a credit. That will always be true. So just because you're rolling for credits does not mean that you're managing risk. In fact, if you're doing it for the wrong reasons, you are absolutely increasing your risk. Remember, price is not risk. It's not about that you've lost less. Risk is about the probability for a loss. You are increasing your chances for a loss. So what are some of the ideas behind rolling for the wrong reasons? Well, if you're doing it just because you can collect a credit, but you're not realizing it's a net payment for an insurance policy. Remember, when you roll for, let's say, a $4 credit, really what you're doing is paying a $1 insurance policy. You're giving up 5 points of potential gains in exchange for $4 cash. Now, that doesn't mean it's a bad deal, but what you don't want to do is to roll for a dollar credit and therefore pay a $4 policy to insure a dollar. So another wrong reason is, let's say, when you think you're managing risk, but you're actually pushing the break-even point further away from the current stock price. So just remember, even though rolling sounds good on paper, hey, I'm getting cash off the table and I'm reducing the amount that I can lose, and hey, who doesn't want to get credits? Let's get paid from our position. Those are all illusions. There are right reasons for rolling and there are wrong reasons for rolling. So the big thing I want everybody to watch is when you're rolling, make sure that you are either guarding against a potential risk, that those embedded vertical spreads aren't getting too deep in the money, or that you're actually giving yourself a better chance for success, not that you're pushing those break-even points further and further away, almost ensuring a guaranteed loss. When you understand the details of rolling, you'll be on your way to making more consistent profits. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.